Okay, welcome everyone. We'll start our second lesson, and in which we'll cover LO2. LO2 is Learning Outcome 2, Investment Analysis, and my name is Anjum Satha. If you have any question, please feel free to drop me email, and I'll try my best to get you back as soon as possible. We'll start our second lesson, and before starting our second lesson, we'll go through and we'll recap what we learned during our first session. Okay, so first lesson, anything you remember from first lesson, what we learned?
There was quite a lot actually, a lot of different types of, the functions, and there was the intermediaries, and all the different debts and equity.
So what is the difference between primary and secondary market?
Primary is like the first time that you go to the market, you might have kind of a new issue. It is basically where traders and intermediaries, buy and sell. And if the shares that would have already kind of taken place.
Great. And what about the money market and capital market?
The money market is basically kind of, it's smaller investments, it's shorter. The capital market's large. Buying, investing more in the company, providing loans for things like capital expenditure or capital equipment and capital, big projects, whereas smaller day-to-day, maybe shorter lendings and that. Banks and whereas in capital markets, it's longer term.
Brilliant. And well done. Great. Good. So capital market is more than a year, and money market is less than a year. So today we'll move. Well done. Great. You already recapped. So well done. So we'll go through today what we're supposed to do. LO2, which is understanding the regulations of security trading, new issues in world markets. We'll go through few markets and we'll discuss identify regulation and procedure used in trading securities, analyze the policies and procedure relating to trading of securities and new issues in the world market, and review issues in global market, including London Stock Exchange. So that's different sort of issues we can, and especially they mention inductive content, sometime a bit slightly not fully relate with the assessment criteria, but we'll try to address within it. And derivatives, which we'll go through, we'll discuss, forward contract, what is meant by financial futures, financial options. So all we discussed during our lesson 2, and these are the inductive contents which we're supposed to learn. And we'll start now. So welcome everyone. We'll start our second lesson, which is based on LO2, understand the regulation. We have 3 assessment criteria which we're supposed to address under this learning outcome, and we're supposed to learn. Okay, what do we know about the derivatives?
I think I can't remember much about them, but are they kind of where there is a sort of a speculation? Is it speculation in the market?
Yes, you're right. Normally in economics and another subject, we'll say change in one thing, what effect will be on the change another thing.
Right. Okay.
How much we can derivate, like, standard deviation.
Yeah.
Yes, how much you deviate both sides, right or left, from the middle. So derivative is quite, we can look around what is, because last lesson we discussed about hedging. What is meant by hedging?
Yeah, protecting and securing, and then kind of forward, protecting, say, interest forward.
Brilliant. So derivative mean the change is we can protect it by using different tools. We can, mutual agreement can be for the future contract, we can protect. We can give the option to swap, one things to other in shares and various other securities.
Yeah.
So all, this is all about the swaps. And
great.
The change.
Okay. Yeah.
All about the protecting. Why we are doing this? risk management.
Yeah.
What is meant by risk?
Risk is basically where you see you're trying to protect against some risk that may or may not happen. And there's different levels of risk as well. You know, you might equity. Equity is a great risk.
Yes. So risk is mean the probability.
Yeah.
So risk is a probability. So probability
and also the severity if it does happen.
Yes, well done. So risk can be high, low, medium, whatever we can call. We can categorize risk and we can use different risk management. Sometime in some people use different approaches of risk. Tara and Sarah, we can say we can transfer risk by getting insurance. We can avoid risk. We're not doing it. We can reply risk, yes, response. And we can accept risk.
Yeah.
Yes. We can share risk.
Isolate risk as well.
Yes. So in international trade, we can share risk, by making joint ventures, joint partnership, involving others. Yes. So that, will help us because sometimes we do not understand the culture and the market and the regulation. So these all, the things will help us to protect to minimize the risk, basically.
Yeah.
And hedging is one of, in terms of the currency exchange, we can protect. Okay.
If you have shares, you can have a portfolio of different shares, which means that, you will get earnings from those at different times, and you spread the risk as well.
Excellent, because of course portfolio normally it's important. Don't put all your eggs in one basket. So always good to be you spread your investment in different things, because it's a housing market, in the oil industry, in different. Yes. So when you're in different industry, you have a different times, as well, so you're getting dividend. So when you have a different times, you're minimizing the risk. End of the day, in a business, of course, whatever the business we are in, we supposed to face some sort of risk. So we, as a business person, we need to make sure, in an investment, in any sort of investment, we're supposed to minimize the risk. Or how much risk, normally, higher the risk, higher
the higher the risk, the higher the returns. The lower the risk, the less.
Yes, high risk, high reward. Yes.
Yeah.
So risk we call beta. What is meant by beta? Beta is known as a risk factor. Beta in finance we call the risk factor. Higher the beta, higher the risk factor. What we'll say, higher the return. Yes.
Yeah.
Okay. Have we ever heard about junk bond?
Yeah, these are bonds kind of at the moment. I think in this.
Junk bonds.
So the company might,
Junk bonds are the bonds. If it's a new company and want to issue a bond, that will be the junk bond. It can be trade in different stock market. Is normally they have a rating maybe C++. Yes.
Yeah, Moody's and what do you call it? Standard.
It's more than C, not less than C. They don't cluster as a or B rating bonds. So the C, C++, whatever we can give them numbers. So those are the high risk, the company recently in a business, but you're expecting return could be around 30+%.
Yeah.
So return can be very high, on these bonds because you're bearing the risk, the risk is quite high. So these are. Okay. So as we earlier mentioned, today lesson we're supposed to learn go through derivative, description, evaluation, forward contract, financial futures, and financial options. So all which we'll go through. Okay, last lesson we explain also as well international money market and the complex financial instrument which we deal within a stock exchange. That's why there's a lot of legislations, stock exchange legislations involved, and we supposed to be registered with the company house. We're supposed to be registered with stock exchange, for especially public limited company, those issue shares to the public, and they have to follow the regulations of the stock exchange. So financial instrument, the role of a money market, the role of treasury function, all this we discussed during last lesson. International money markets and the complex financial instrument. Financial instrument we discussed during last lesson as well. Coupon bearing, discount, derivatives is a standard contract. Tick size and margin and basic risk. Short-term liquidity, what effect will be on the short-term liquidity? What is meant by liquid?
Liquidity is basically to do with kind of the liquidity is your kind of your assets minus your liabilities.
Yes, liquid mean is near to the cash, more near to the cash.
Yeah.
Are easy to convert into the cash. Trade finance, risk management, all this we'll discuss as well, which we'll try to link with the short term, long term. Okay, I copied one link.
Okay.
So I think so. Maybe it's work on your end or not. Hope so you can.
Where did you get it from?
So I'll send you in chat box. You can click your end as well if not work or you can't see properly. So when you copy this and okay,
hello and welcome. Today we'll be providing a brief introduction to financial derivatives. This video is only to provide a general picture of what derivatives are. The four most common types of derivatives will be examined in greater detail in standalone videos in the coming weeks. So what exactly is a financial derivative? Well, in its most general sense, a derivative is a contract whose value is based on something else.
So it's a contract which is their value based on something else.
The term financial derivative refers to security whose value is determined by or derived from the value of another asset. The asset from which a derivative gets its value is known as the underlying asset, or simply underlying.
Underlying
asset can take many forms, but it commonly refers to stocks, bonds, commodities, currencies, interest rates, and market indexes. The most important thing to take away from our discussion of derivatives so far is that their value depends upon the value of something else, the underlying asset. So, the change in the value of a derivative's underlying causes a change in the value of the derivative itself. This is all well and good, but what's the point of derivatives? Well, there are two main uses for derivatives. The first is to hedge risk. Derivative hedging generally refers to the
hedge risk, how we can minimize it.
Objective of minimizing risk in the physical market. In order to demonstrate how derivatives can be used to hedge
risk, it's quite a good example.
Consider the example of wheat producers and cereal manufacturers hedging their exposure to fluctuations in wheat prices. As we know, wheat is susceptible to significant fluctuations in price, owing to both supply and demand. Fall in the price of wheat is bad for wheat producers because they can get less money for their crops, but is good for cereal manufacturers because they can get one of their key inputs at a discount. On the other hand, an increase in the price of wheat is good for wheat producers.
Can you see properly? Yes.
Money for their crops.
I can see, but I can hear.
Because it increases costs. So it is in the interest of wheat farmers that the price of the two parties can enter into a contract fixing the future price at which the wheat will be sold. For example, A wheat producer might agree to sell wheat to a manufacturer in 6 months at the current market price of $12, regardless of what the market price for wheat is in 6 months. By locking in the price of wheat, the producer is seeking to protect his or herself against an expected decrease if they hadn't signed the contract. In 2 directions, up or down. This example is a zero-sum game, possessing both a distinct winner and a distinct loser. Basically, the interest of only the wheat producer or the cereal population is fundamentally different from derivative hedging. Insurance policies. While speculators are directly driven by the opportunity for profit. Now that we have a basic understanding of how derivatives are used, with this in mind, let's begin with forward contracts. A forward is a custom. Unlike forwards, they are standardized and regulated so that they may be traded on a futures exchange. Futures are often used to speculate on commodities. An options contract is a contract that gives the right, but not the obligation, to buy, call, or sell, put, a security. So we have seen that derivatives are contracts whose value is based on something else. We have seen that they can be used for either hedging or speculating, and we have briefly touched on the 4 main types. This brings our overview of financial derivatives to a close, but please stay tuned for our videos on forwards, futures, options, and swaps. Thanks for...
Okay, so you can play your end. I think so is the issue with the speakers because of course, we played the YouTube. So this link, you can watch. It's quite good examples like, the wheat farmer and the cereal manufacturers. So if the wheat price will drop, is a benefit for the cereal manufacturers. So it means the farmer is going to lose. So we need to be look around hedge as well. We can make, the agreement is a contract, future contract that will help, to be minimize the risk. Yeah. Any question? Any question? We okay? Hello?
Okay. Yeah, can you hear me?
Yes, I can hear you now.
Yeah, I'm okay, thank you.
Okay, so next, derivatives are the key tools in a risk management. Here we can introduce a derivative is an asset whose performance or hence value is derived from the behavior of the value of underlying asset. The most common underlyings are the quantities like T, or the various other things, shares, bonds, shares, and the currencies and the interest rate. So interest rate increase and decrease that affect the value of the shares as well. The currencies values increase and decrease in the foreign currency that also affect on the share price as well. Derivatives are the contract that give the right and sometimes the obligation to buy or sell the quantity of the underlying or the benefit of some others ways in the rise fall in the value of underlying. So that's really we need to be manage the risks, so underlying assets. So derivatives include forward rates agreements, futures, options, and swaps. So what is meant by forwards? Forwards and the futures effectively fix a future price. Option give you the right without the obligation to fix a future price. The legal rights is an asset with its own value that can be bought or sold. So the use of derivative is managing the exchange rate risk, and the interest rate risk can be explored by, we can further, click, is a link there. Yes, foreign exchange rate risk management and the interest. What is meant by base rate?
That is the lowest rate, the lowest.
Lowest. Who set the base rate?
Is it set by the banks, the central bank, or, or the ECB, or?
Well, then that's, the central bank. In other country, we can call state bank.
All right, okay.
And its effect, huge. Whole the money market, effectively is a work, like a currency. Currency when we'll issue, if we want to increase and decrease the supply of the currency in the market, so we can increase or decrease the reserve of the commercial banks. in the state banks or the central bank we can call. So that's we can all the economics, the risk we can minimize, and ultimately these affect in the stocks as well. So forwards, what is meant by forwards? So derivatives are not fixed in the volume of the supply like the normal equity or the bonds market. Their existence and the creation depends on the existence of the counterparties, and the market participant will take the alternative views about the outcome of the same event. Some derivatives, future and options, traded on the exchange where the contract are standardized, and we can look around the guarantee exchange rate as well. We can say, okay, we can agree on the certain rates. We can look around the higher and the lower in the middle. We can use high and low method as well to identify. Okay, can you see now?
Yes. Yes.
Okay. So derivatives are not fixed, we can look around, and of course the future, and we can fix our currency exchange rate for the future contract, forward contracts, yes, where we can use the hedging, and we can look around, the price won't be changed. Other transactions are over the counter, where the financial intermediaries put together a product which we can precisely the needs of the clients, where the valuations is the issues and the credit risk may be arise. So thus we can look around the forward contracts. What about the future contracts? These are all the derivatives mean contract. So future contract, there are the two ways of closing a position: deliver the underlying on the maturity date. Okay. Is it okay? Hello?
I'm just typing to you. I have completely different slides for Unit 2. I have them in Moodle.
Okay, I think so you downloaded from this slide, I think so it's not still available on Moodle, huh? Which I'll send you end of lesson. Huh? Yes, I'll upload this on Moodle as well. Basically, the last previously this delivered is purely based on the international, so I included all the terminologies as well. Next, my slides will be exactly the same, huh? But I'll make sure next time I'll upload before. Okay,
Well, the slides that are up are all American kind of related slides.
Yes, basically I prepared all the slides which is based on the inductive contents, yes, all the terminology.
I would have thought they should be based more on the UK because
yes.
Yeah,
so
the slides
we can
are all US slides.
Yes, that's fine. We can discuss, and we can include more slides. Okay, so we'll finish this and then we'll discuss about the stock exchange. According to assessment criteria. Okay, so future contract. We know the future contracts, yes?
Yeah.
So what is meant by future contracts?
Can we take it? Oh God, okay. Future contracts. Are you kind of putting values ahead?
Yes, because that's a future transaction.
Yeah.
And future transaction, what do you think? Future transactions are, is there any risk within it?
Well, yeah, there would be a risk, yes. And is there hedging done on that as well?
Yes, because the reason future risk is always, the currency, we're not certain what will be happen, Brexit and various other things. So a lot of, the company, they are entering into future contract, but they are going through the hedging options. Yes, you and me, we can agree, we'll charge this price, doesn't matter whatever the contract will be. Yes?
Yeah.
will be whatever the tariff will be in terms of the taxes if is deal, and we can agree on these.
Yeah.
So tick size, a tick is the standardized minimum price movement of a future or the option contracts.
Mm-hmm.
Yes, so we can tick, that's the price. We're not going more than this and that. So we'll stay in between those prices or in those exchange rate.
Yeah.
Sticks are the useful for calculating the profit and loss on a contract. Yes, we can calculate what profit we'll make, what losses will be if it's happen in, because we decide the boundaries and we'll stay within those boundaries.
Yeah. Okay. Yeah. Yeah.
What is the difference between margin and markup?
The markup is basically based on the cost, the purchase cost, isn't it?
Well done. So markup is based on the cost price, cost value, and the margin is based on the sales value, and both are known as a gross profit.
Yeah.
Okay, so potential problem dealing with the future is having made a profit or other party of the contract therefore made a loss. Default on the paying you your profit, and this is the term counterparty credit risk. Whoever the buyer and the seller contract don't act with each other directly, but via the member of the market, therefore the market clearinghouse. What is meant by market clearinghouse?
Um.
Like, let's think about the bank clearing. Check is going to in a clearinghouse, yes? If you give me check your bank and my bank is a different bank, is going to in a clearing, yes?
Yeah.
And that's a called clearinghouse, yes, where we clear the check. How much you owe me, how much I owe you, how much you owe me, we can balance in our books. Yes? One can be liability, one can be asset.
Yeah.
So exactly the clearinghouse where the securities, yes, and the transaction can be regulated. The effectively reduce counterparty default risk of those dealing in future. The clearinghouse is acting guarantor for all the deals. It needs to be protect itself against its different types of the credit risk. Thus, so like limits. Have you heard about the limits? Like auto buy and auto sell limits. We can set, the London Stock Exchange, they introduced the system. It's called auto buy and auto sell. Yes. So auto buy and auto sell shares meant by if your share prices will go up to certain, you're saying to system it's auto sell. Yes, auto will be available to sell.
Okay. Yeah. Yeah.
And the auto you can buy it as well. You can list them. You can say the fund in your bank, and then you can auto buy as well. Especially HSBC and various banks are offering those sort of things. So future contract and exchange traded forward agreements to buy and sell underlying the assets on future dates, agreed price and future like forward contracts. The company is in a position to fix by the rate of exchange. In the future contract, it is binding contract. Future contract differ from the forward contract following ways. Future can be traded on the future exchange. Yes, not current exchange. The contract which is guarantee the price known as the future contract. Separate from the transaction itself, and all settlement takes the place 3 months cycle, which can in every quarter, and the company can buy and sell September future, December futures, and so on. The futures are the standardized contract of the standardized amount. For we can look around. Yes, CME is a stock exchange and trade the sterling futures contract with the standard price, and only whole multiply this amount can be bought or sold. We can set the limits on initial margin. What is meant by when the future position is open, the clearinghouse required that the initial margin placed on the deposit margin amount to act on the security and the possible default. the objective of the initial margin to cover any possible losses made from the first day of trading. The size of initial margin depend upon the future market, the level of volatility. The market is quite volatile, especially in the stock exchange. And the initial margin, like here, yes, 500,000, 3 months sterling contract traded live 7 is 50, and we can say this is the margin, yes, as a percentage. So some investors use the future for the speculation rather than the hedging, and the margin system allow the high leverage, but we can. Okay, what about the variation of margin? The end of each day, the clearinghouse calculate the daily profit and loss for the future position, and this is known as the marking to market. Yes, according to the market, we can decide what will be the profit and loss of the transaction. The profit and loss is added to the subtracted the margin amount of the balance. This is all about the system which we can set. Either you can based on which margin you want, variation margin or future hedging calculations. We can look around how we can do the first step. We can follow the 3 steps. Set up the hedge by addressing the key questions. Do we have initial buy or sell futures? If you want to sell a quantity in futures, then hedge. You should set up the future position by selling the associated future contract by for that quantity. We can look around how many contracts you want to sell. Yes, which expiry date should be chosen. So all these things, of course, will be effect on your profit as well. The second, the contract the exchange. Pay initial margin and then wait until the transaction and the settlement date, and calculate the profit and loss in the future market by closing out the future contract. Does it make sense?
Yeah, okay, yeah. As I said, I studied this before at the University of London. I'm just going to go and refresh it, but I have studied all this stuff before.
Oh, great. Brilliant. You know more than, well done. So you know stock exchange well.
Yes.
Okay, so next now. Options. What is meant by options? Options are similar to the forward and other price fixing contract, but one key difference, they give the right but not the obligation to buy or sell underlying the asset, and at some point in future determined rate. Yes, the company can either put and call. What is meant by put and call? Put and call options. So put give you the right to sell, and the call option give you right to buy. European versus American. European options can be expressed on the expiry date of option, and American option can be exercised at any time to and including the expiry date.
Yeah.
Other Bermuda options is a combination of American and all, exercise on the expiry date, and the certain specified dates occur between the purchase date and the expiry date. What about the next, OTC and traded? So OTC options can be, we can specify it, and normally European options, and traded options are standardized. Both term, size, and the date are bought or the sold recognized exchanges, and the normally American options. Any questions? Okay. Risk. Managing regulatory risk. Risk is quite huge risk in terms of the stock exchange. Always, the Security Exchange Commission, they carry on looking and investigating how they can minimize the risks, especially now is the risk, the people can manipulate the prices a bit, so like we heard about the guy from London, a bit, is for a few seconds, they change the prices of the shares in the New York Stock Exchange, and our billion is being. So we can look around these sort of the frauds, and the risk is there as well. Managing regulatory risk, we can pass some legislation, identify applicable regulation, understand the impact of these, develop regulatory risk plan, and ensure all the project company with the plan and monitor and keep, normally you identify the risk, yes, you try to minimize them. Any question? Large company may have a resources to set up permanent regulatory team in our organization, incorporate the role within the internal audit department. We can consult the firm specializing in regulatory risk, and practice research suggests that many firms don't sufficient resources in the area and expose the high degree of regulatory risk. Any question?
No, I can actually.
Okay.
Risk management, this particular module, because it's the very same. It's just one's health and safety, and the other is actually finance.
Yes. So option of hedging calculations. Step 1, we can set up the hedge by addressing the 4 questions. Do we need to call or the put option? How many contracts? Which expiry date should be chosen? And which strike price or the exercise price should be used? Contract the exchange and the pay upfront premium. The wait until the transaction and the settlement date. And the third, of course, on the transaction date, and compare the option price with the prevailing market or the spot rate. Do we know the very well spot rate? What is meant by spot rate? What is?
I'm just trying to think.
Do we know what is meant by?
I can't remember now.
It means the rate at that date when we trade it.
Oh, right. Okay. Yeah. Okay. I'll write it down.
That's the instant, because the security exchange, especially stock market, rate in a second change. Yep.
Yeah.
When you click it, you agree that spot rate, that's gone. So whether the option should be exercised or allowed, so we can look around and calculate the net cash flows. What will be? Okay. Then all these learning outcome being addressed, like types of market we discussed during last lesson. Yes, we can discuss, the money market, capital market, primary market, and secondary market. Primary market, you already know. Yes, first time, we can. First public sales of the company stock. Required the Security Exchange Commission approval. Of course, if we don't have approval, we can't really sell it. 3 choices of the market security in the primary market: public offering, right offering, and private placement.
Yeah.
We know the difference between them?
Yeah, I'm fine with those. Yeah.
Okay, brilliant. So an offering?
Yeah. Right offering is kind of new per time. A public offering is where it's paid to the public, and a private offering is just paid. A right offering is basically where you have shareholders on. You have already.
Yes.
Offer at that rate, based on the number of shares they have. So it won't dilute their shares.
Yes, well done. Great. Yes, you're right. So next, this is the example. Yes, we can look around number of IPOs, average first day return percentage. Yes, gross proceed, how many millions we have. So that's the data. We can look around in the stock exchange, going public, underwriting the offering, promoting the stock prospects. So registration statement describing the issues and the issuer. Issuing, and then of course we can decide nominal values. Yes, what will be values if you're selling more than that is a premium, share premium, what will be? So is it, what do you think? Company can issue as many shares they want? Hello? What do you think? Can we issue as many shares we want to issue? Hello? Yes, what do you think? Is there any limit to issue the shares?
I think there is, yes, based on the actual, what was incorporated, the certificate of incorporation. Doesn't that determine how many shares?
Yes, we need to be, first of all, we need to register the registered capital in the company house. We're not supposed to be issued more than the registered capital. So we not issue shares more than the registered capital. And if we want, if we need more money or more finance required, so what we can do, we can increase that. We have to call the meeting, AGM, which is extraordinary general meeting we can call, and where we can, and then we can send the application. But of course, when we'll issue more shares, of course, the people already have a share there, the share price will be affected from it as well. Earning per shares will be decreased. So then we can look around all this primary prospectus is available during the waiting time, quiet period, the time period after the prospect is filed, and when the company must, restrict, what is said about the company, and the road shows. Series of presentations to present the investors. They will buy our shares. That's the example of cover prospectus of the company. Yes, how many shares, what will be, and signed and offer. And types of the investment banker roles, underlying the issuing, purchase the security at the agreed on the price, and be at the risk of reselling it to the public. What about the syndicate? The group formed by the investment bankers to share the financial risk of underwriting. Yes, can be underwriter. Selling group, other the broker firms that help the underwriting syndicated to sell issue to the public. Public announcement to issue the role of participant underwriting process, and investment bankers compensation typically in the form of discount on the sale price. What do you think? Can we normally sell less than the face value or more than the face value?
Who's selling? Like, is it also, is it face value? Yeah, I think face value.
Yes, we tried at least, the face or the above than the face. But if it's the company totally new and we need money for it, we can be at some losses as well, yes?
Yeah.
Which loss can be set. So the selling process at the large security, investment banker leads investment bankers, all these, yes, underwriting and purchase of securities, yes, selling group, and the purchase of security, which can be through stock exchange. Secondary market, where we not selling first time, yes, the market of the security traded after being issued, and the role of secondary market, liquidate to the security purchaser, provide a continuous pricing mechanism, security exchange forums, where the buyer and the seller of the securities are bought together to execute trades. Imply all electronic trading, which is, of course, nowadays all the even world stock markets is interlinked with each other as well. And is the international various regulatory bodies, even the monetary funds, and can say your stock market need to be well regulated. And over the counter market involve the trading in the smaller listed securities. So can be broker market is a huge broker market, yes?
Yes, yeah.
So consist of national and regional security exchange, It can be London Exchange, then other small exchange as well. 60% of the total.
That's America. What about the UK? Do you have a London?
Yes, we have a London Exchange, then we have an index as well, different index of London Exchange, and then it's been categorized into different. The small trader, you listed by index 50 or 100 or, yes, 500.
Yeah.
So it's a different size and the different companies.
Yeah.
And the broker market, like in other countries, you can say the New York, Washington Stock Exchange, New York Stock Exchange. New York is dealing with all over the world as well, yes. But the regional investor can be the local stock exchange as well.
Yeah.
Okay, so they trade and buy and sell. Dealers, of course, consist of both, and the trades are executed with the dealers, and the market in the middle seller sell to the market and at the stated price. The middleman can earn huge because they know the risk. They do the regular study of the companies, which way they're moving around, which new product. That's why the information leak early can be beneficial for various investors. Have we heard about Enron? Enron company?
Robert Maxwell in the UK. And Enron, yes.
Yes, World Telecom and Enron, those been, of course, liquidate.
Yes.
And they shown in the millions profit. They overstated asset, they understated expenses, they overstated profit. So after a few months, company can't afford it to pay to their worker salaries and things, So secondary market, broker market, and the dealer market, national exchange, New York, yes. Then the regional exchange, you will see the list of, and then the global markets, yes.
Yeah.
Global stock exchange and OTC, of course, on counters.
The counter, yeah.
Okay, broker market, largest stock exchange, our 2,700 companies, our 350 billion shares of trade traded, account 90% of the stocks traded and exchange, specialize, make the transaction in the key stocks. New York Stock Exchange, formerly American Stock Exchange, more than 500 company listed. So that's why the stock exchange system is listed, yes, into size as well. Regional stock exchange, typical can be 100 to 500 companies. Option exchange allow trading options, the best known as a Board of Options, CBOE. Yes, so these are all dealer market. Of course, different dealer. Bid price, the highest price offered by the market maker to purchase a given security. Ask price. These are the key, the terms carry on using. The lowest price at the market maker willing to sell at a given security. Sometimes can be high and low, depends on the various, it's a new legislation, new tax rate is going to be introduced. Of course, they which increase or decrease the investor interest as well. Larger dealer market list the large companies like, the Microsoft, Dell, and various other companies. Off the counter, listed smaller companies cannot or don't wish to be listed in the big. And over the counter, pink sheets, yes, listed small means they don't regulated by the security exchange. Liquidity is minimum and almost non-existent. Very risky, many nearly, like we said, junk bonds, yes. Alternative trading system, third market and fourth market. What is meant by third market?
Third market is basic.
that are not member of the security exchange, institution investor, yes, mutual fund, life insurance companies, pension are reduce, trading costs due to the large sub transaction. Fourth market is the large institutional investor deal directly with each other to bypass the markets, yes. Electronic communication allow direct trading and most high volume. Basically, at end of the day, they're cutting the middleman, yeah.
Yeah.
To reduce intermediaries and general market condition. Of course, we can look around favor market, rising price investor, bear market. Yes,
The opposite.
this is the opposite of
Yeah.
which we can look around and the globalization of security market. Diversification, inclusion of the number of different investment vehicle in the portfolio to increase the return and the, like you earlier very well mentioned, yes, portfolio, yes, diversification.
Yeah.
So you already maybe learn, the portal generic strategies like companies, diversify. We can look around the shares as well. Use of international securities, improve diversifications. More industry securities are available. Yes, securities, different, currencies and different size and options. International investment performance opportunity, high return. Foreign security market don't necessarily move with the US market really, because we don't need to be follow. Of course, the European have own systems. In term of the US, they slightly different terminologies as well in the stock market. So that's really we need to and globalization securities, indirect ways to invest in the foreign securities. Yes, purchase shares of US based multinational companies. Direct ways in investment in the foreign securities. Purchase securities on the foreign stock exchange. Buy securities of foreign companies trade and buy American. Of course, these are the receipt dollar dominants, different size and form. And risk of international investment. Usually investment risk still apply. Government policies like no, especially a lot of discussion was yesterday on BBC, especially the between Iran and EU and American and a lot of company invested when these sanctions were removed. So this is the risk, the government policies, different government policies can be impact on the various companies as well. Those set up and listed and set up new and now moving around again sanctions. So that's is a huge risk for the companies. Currency exchange rates, value of foreign currencies fluctuate compared to US dollar. Is it really we need to trade? Can we trade in any currency? Or you think is really we need to trade in US dollar?
Sorry? Can we trade in any currency?
What do you think? What are your views? If you want to buy a shares, yes, because we can trade in different currencies. Yes, it's not compulsory. Different legislation we can say no, you can't trade in local currency. We all trade in the US dollar. Yes, but no, because this is because depends, some government policy they want foreign exchange more to come in a country, but some they just of course end of the day we want to boost the business activities, so we need to look around, and that's the decision making as well. Regulations we need to trading hours of security, that really matters as well, because like in Middle East and various countries they have a, for suppose Friday and Thursday is a holiday day. So is different trading times. Yes, that's a huge impact as well. Some may be saying no problem, we can extend the time to be look around and provide more option to investors. So regular trading sessions for US and these are the times, extended hours, electronic tradings. Yes, it can. Okay. Regulation of security market, inside trading, and blue sky laws. What is meant by use of the non-public information about? You maybe learn about semi-strong, strong market. Yes, market. You maybe learn about in the financial management semi-strong, strong market, yes. Some market is information is a public domain, yes. Present and future information. So use of the non-public information about the companies to make profit transactions. And laws imposed by the individual states to regulate seller of securities and intended to prevent investor from being sold nothing but blue sky. So we use the term regulation security market, yes, different act required full disclosure of information by companies.
Is that the American Act now, is it? Those acts, they're the, are they? Those acts, are they? Sorry. Yeah, those security acts, are they American security acts?
Yes. These are more American security acts, yes. All of the country, they change it according to their own legislations.
Yeah.
So it required disclosure of information by the companies. Security Act 1934 established Security Exchange as a government regulatory body. Then, of course, various other acts allowed set the regulation of the security industry through the Trade Association, National Association of Security Dealers, and Investment Companies Act.
I think in the UK, isn't it more the Companies Act, and also isn't there the Comply and Explain more in the UK?
Yes, we have a Company Act 2006 now we are using. It used to be 1984-87 before.
Yeah.
So it's been updated. So Investment Advisor Act.
Security. What is that in the UK? There's all these like Turnbull reports and Cadbury reports and all of that, and I think it's more that in the UK than.
Yes, those are the governance reports. Yes, Turnbull and various others.
There's a load of them. Yeah.
How we can govern it? Yes, you're right. Like Sir Bonnet. So these are the reports being published by the people and the organization, and then those become an act as well. So that's why it's more, some countries a principle-based approach, some countries a rule-based approach. Do we know
legislation, whereas in the UK it's more kind of apply and explain.
More based on the case laws, yes. Because the UK law is not written, is more based on the case laws, yes.
Yeah.
Whenever required something implement it, it can be court give the ruling and they become a case in the wider interest of the public. So that can be used. So Security Act Amendment 1975 abolish the fixed commissions and establish the electronic communications and insider trading and the Fraud Act. Of course, Fraud Act is it's a lot of the fraud being amended. A security exchange even can ask where your money came from. Like a lot of the foreign investors, they have money bribe and various other So even you buy the shares can ask where the money came from. Because under the Fraud Act as well, basic types of security transaction: long purchase, investor buy and hold the security, buy low and sell high, and make money when the price go up. And the basic types of security transaction: margin trading, like earlier we said, yes, use borrowed fund to purchase securities, current owned securities used as a. What about can we use one security to buy other securities? Yes, we can.
Yes.
And because depends margin requirement by Federal Reserve Board, like in America, determine the minimum. We have a Security Exchange Commission to regulate these. SEC, and on the purchase with the 50% margin requirement investor put, and the broker lend remainings. Okay. So the initial margin requirement, various types of security, listed common and preferred stock, minimum initial margin, equity required. Equity mean the investment, yes?
Yeah.
So that can be, it can be bonds, corporate, uh, government can also issue the securities and the notes and the people can buy as well. Yes,
Yeah.
invest like euro bonds and various others. Options premium plus 20 of market value underlying stock, those can be. Futures 2 to 10, of the values of the contracts.
Yeah.
And margin trading advantages and disadvantages, allow to use financial leverage. Signifies profit at disadvantage. Of course, we can look around the losses and identify expenses on the margin loans and marginal calls. Okay, we can use the formulas, basic margin formula, value of securities minus the debt balance and divided by the value of security. V minus D divided by V. So we have here and divided by, so we can say what is example of using margins. Yes. Any question? Okay, the effect of the margin trading on the security returns. How many shares we have, what margins we'll use, yes. What value of the stocks, this carry on investor position, and the price falls. If the price falls, of course, what will be, and the return on the investment.
Return, right, yeah.
Either it will be profit or loss.
Yeah.
Okay, return on investment, total current income received, total interest paid on the margin loan, market value of the security at sale, and minus market value of the security at purchase. So return on investment. Yes, so all this we can calculate what is we are making it, yes.
Yeah.
Short selling, investors sell security they don't own.
Yeah.
Investor borrows securities from brokers, yes. Sell high and buy low. Of course, that's a common rule, yes, sell high and buy low, because if you want to earn the profit, you need to okay. Short selling, yes, advantage, disadvantage as well, limited return opportunities. We know the opportunity cost. Sorry, what is meant by opportunity cost?
Yeah, it's kind of other kind of charges that come in, that are related to.
Yes, you're right, but
No, yeah. If you do, say for example, if you kind of you invest in shares, and you could have done something else.
yes, so like is a security, so opportunity, like we are doing this lesson, but you're missing other opportunity. So what is the cost of that, and what is the benefit of this? Yes. So always you measure the cost and benefit. So if you're buying one stock, you're missing the opportunity to buy other stock. Which stock will give you higher return? Yes. The opportunity you're missing, what you're going to lose. Ultimately, you're looking the cost and you will do normally cost and benefit analysis, and because you want to maximize your return.
Yeah.
So that's we can look around the what is margin position of each type of the stock. And I copied this, the link as well to read, the Kaplan, yes, the securities and a bit, article on it as well. And that's all really all about. So today we discuss about what is meant by derivatives, what those are, what type of regulations we can or we need to, or how we can analyze or read it about different security exchange. We mentioned few security exchange, identify the regulation and procedure used in trading. Of course, we discussed, we need to be, yes, listed and all, the options we discussed. analyze the policies and procedures. Yes, each security exchange, we can analyze the procedures of the new issue world market or the small or the local stock exchange, and all the options and the forward contracts we discuss. We can hedge as well if we want to as a company. Review issues in the global market, including the London exchange. Of course, is a different issues we can discuss. The risk is a huge there. Yes, that's why a lot of legislation being Sorbonne Act, was to be regulate more and more transparency there. Yes. So what I'll do, I'll send you few reports like hedging, Hedging reports, and the green and the Tonburn reports, and various other reports, Serbans and various others. These all about the governance. Yes.
Yeah.
Security exchange. So those all been looking different ways to improve and more transparency. Every day is more transparency. So because we'll try to give the fair shares to the investor instead of we'll cut the middlemen more, or we can best regulate where we minimize the risk for investors. More transparent. Any questions?
Link as well to the wheat farmer, because I didn't get all of that. The link to the video that you put up. If you see the link to that as well, please.
Yes, no problem. And what I'll do, I think so Sumit already sent you the slides, huh?
Thank you, brilliant, excellent, because I can print them out today if you can send them to me.
Okay, no problem. What I'll do, I'll sorry, if you don't mind to give me your email, just message.
You have it. I send you an email. I'll give it to you again.
Okay. So what I'll do, I'll send you as soon as possible. Okay.
Brilliant. Yeah.
I'll send you all the links. I have few books as well on Security Exchange Commission and some legislation. So if you want to reference in your assignment, you can use them as well. So which I'll send you as well. Okay. Great. Thank you. I can send you now. So that's I can send you.
Thank you.
Any question?
No, absolutely not. No, I'm going to, as I said, if I had the slides, I'll print them and I'll go over them all and be great.
Brilliant. Maybe we can look around. We can go on the website London Stock Exchange. Yes.
Yeah, great. Yeah.
Or I can send you some if you want. I have some thesis. Maybe I can send you if you're really very keen. Somebody did research.
Yes, I am. I am. Yes. Thank you.
Great. Hope so. Further. Okay, great. So have a nice weekend. I'll speak to you next week. And if any questions, feel free to drop me email.
Thank you very much.
And,
also,
nice.
the units for lecture, maybe 3, you could review those as well that are up because of.
Yes, that's fine. Because the lecture 3 I'll send you well before, and we'll go through LO3 next lesson. Okay, great. Thank you. Have a nice weekend.
Yeah, that would be great.
Yes, sure. Thank you. Have a nice weekend. Have a nice time.
You too. Have a lovely time, and thank you.
Okay, brilliant. Thanks, everyone. I hope so. I'll see you next week. So today we cover our LO2, and it's my email address there. If you have any questions, then I'll get back to you as soon as possible. And have a nice time. Hope so. I will speak to you all next week. Thank you. Bye-bye.